$64.19. That is the number currently dictating the heat map of your brokerage account. While most of the internet was distracted by AI memes today, the energy market just did a violent 180-degree turn. Yesterday, we were told a nuclear deal in Geneva was imminent, and oil prices slid to a two-week low. Your gas hedge looked great, but as of late this evening, February 18th, 2026, the vibe has shifted. The geopolitical risk premium, that's the extra price investors pay when they're scared of a war, is officially back. If you're sitting on a 401k or a Roth IRA, you need to pay attention because the good progress in Geneva is currently clashing with a 90% chance of military escalation. Here is exactly how this high-stakes diplomacy is about to hit your wallet. Here's the problem. We have two parallel realities. In reality A, negotiators in Geneva just wrapped up a second round of talks. They've agreed on guiding principles. Iranian officials are calling it constructive. In reality B, the U.S. has carrier groups positioned in the Middle East, and Vice President JD Vance is signaling that the administration's red lines haven't even been acknowledged yet. Markets hate uncertainty more than they hate bad news. That's why WTI crude surged over 3% today to close near $64.19. We're seeing a tug-of-war between a supply glut, if a deal happens and Iran dumps 2 million barrels on the market, and a supply shock, if the Strait of Hormuz gets blocked. I'm an analyst, not your personal advisor. This is for educational purposes. Always do your own due diligence before moving your hard-earned capital. Why your index funds are sweating. Let's agitate this a bit. Why does this matter to a long-term VOO or VTI investor? The gold spike. Gold just rebounded to nearly $5,000 an ounce. When gold jumps 2% in a day alongside a strong US dollar, it's a flight to safety. Big institutional money is de-risking. The tech vulnerability. The Nasdaq stayed resilient today at 22,578, but it's walking on eggshells. High energy prices act like a hidden tax on consumers. If oil hits $80 again, which is the failed talks scenario, discretionary spending drops, and those high AI valuations start to look very fragile. The inflation sticky note. We were finally seeing the CPI, Consumer Price Index, cool down, but this rebound in oil adds stickiness. If the Fed sees energy-driven inflation creeping back, those interest rate cuts you've been praying for to lower your mortgage or car loan, they might get pushed even further out. Positioning your portfolio. So how do we play this without gambling? We look at the data-backed probabilities. Scenario A. The deal, the soft landing play. If Iran submits those proposals in 2 weeks and we get a framework, oil likely crashes toward $55. The move. This is great for airlines and manufacturing. It's also a risk-on signal for the S&P 500. However, your energy ETFs like XLE will likely see a 5 to 10% margin compression. Scenario B, the stalemate/escalation, the hedge play. If the 90% strike probability holds true, we're looking at $80 plus oil and $5,100 gold. The move. This is where you look at defense contractors and energy majors, Exxon, Chevron, as a temporary hedge. JP Morgan currently pegs recession odds for late 2026 at 35%, but a conflict pushes that to a coin flip, 50%.
The Ali Abdaal strategy for fire seekers. Don't try to time the headline. Use this volatility to dollar cost average, DCA. If the market dips 2 to 3% on a bad news day, you're essentially buying the US economy at a discount. History shows that geopolitical shocks are usually short-term blips on a long-term upward chart. We are in a wait-and-see period for the next 14 days, while Iran preps their proposals. Expect the headlines to be loud and the markets to be choppy. But I want to hear from you because the community's pulse is often ahead of the analysts. With oil rebounding and gold flirting with $5,000, are you increasing your safe haven assets, gold/cash/treasuries, buying the dip in tech, or just sticking to your boring but effective index fund schedule? Drop your strategy in the comments. I'll be jumping in to reply to the most interesting portfolio allocations. I'll see you in the next update. Stay disciplined.